Welcome to The Explainer. Today, we're taking a highly technical financial concept and breaking it down into clear, easy-to-follow steps so you can absolutely master the cost of capital. I'm your host, and we are unpacking a fundamental rule of corporate finance. Seriously, if you want to understand how massive, real-world businesses actually fund their operations, this is absolutely essential.
Let's just dive right into what feels like a completely backwards concept: how taking on corporate debt can actually act as a financial hack to lower a company's tax bill. I mean, sounds totally counterintuitive, right? Like, why on earth would paying someone else interest keep more money in your company's pocket? Well, it all comes down to the exact mechanics of corporate accounting and the tax code.
To solve this mystery, we'll walk through our agenda: capital borrowed versus owned, meeting the WACC, calculating cost of debt, the tax shield effect, and finally, a case study of debt in action.
Part 1. Capital borrowed versus owned. Okay, before we hit the math, let's briefly align on the basic puzzle pieces we use to finance operations.
Simply put, capital is the lifeblood. It's the funds used to acquire assets and just keep the lights on. It's the core driver behind that classic accounting equation we all know: assets equal liabilities plus equity.
And this breaks down into two very familiar buckets. You've got foreign capital, so your liabilities are debt, which is money borrowed from outside the company, versus own capital, or equity, which is money straight from the company's own pocket. Honestly, pretty much every major corporate decision ultimately revolves around balancing the cost of these two things.
Which brings us to Section 2, Meet the WACC. So how does a company calculate its total funding cost across those buckets to make smart investment decisions? Because, let's be real, neither bucket of money is actually free.
They use the weighted average cost of capital, or WACC. This blends the costs of four specific long-term financing components together: cost of debt, cost of preferred stock, cost of retained earnings, and cost of new common stock. Notice we are strictly talking about long-term capital here. Short-term liabilities like accounts payable, those are deliberately excluded from this calculation. The WACC is really all about the big picture.
Here is the golden rule: the cost of capital must be calculated on an after-tax basis. This is absolutely crucial. When calculating these costs, we only care about the after-tax cash flow, because that is what actually impacts real-world investment decisions. A company doesn't make decisions based on the sticker price of debt. They make them based on the actual cash leaving their accounts after the government has taken its cut.
Section 3. Calculating cost of debt. Let's isolate just the very first component on our WAC list to figure out its true price tag.
Imagine a company issues a standard corporate bond. Let's say it has a $1,000 par value, a 10% coupon interest rate, and 5 years to maturity. This is a super typical scenario for a business needing a quick infusion of cash. They're essentially promising to pay that 10% interest every single year for 5 years.
Doing the initial math, the yield to maturity, or the before-tax cost of this debt, comes out to exactly 10%. I mean, if you're paying $100 a year on a $1,000 bond, your cost is 10%, right? It seems incredibly straightforward. But hold on, remember the golden rule? The calculation doesn't actually stop here.
Section 4. The tax shield effect.
Here is the literal financial hack hidden in our source material. The use of debt will arise interest expense, which affects a decrease in income tax. Let that sink in for a second. Paying interest on corporate debt legally reduces your taxable income. The interest you pay to your bondholders is recognized as an operating expense. And because it's an expense, it shrinks the overall profit number that the government is actually allowed to tax.
Because of that tax reduction, if the corporate tax rate is 15%, that 10% cost of debt mathematically drops down to an after-tax cost of just 8.5%. You just take the 10% cost, multiply it by 1 minus the 15% tax rate, and boom, you get 8.5. Suddenly, that borrowed money is noticeably cheaper than its initial sticker price. It's like a built-in discount.
Part 5, Case Study, Debt in Action. Okay, let's look at how this actually plays out mathematically to prove our initial hook.
Consider two identical companies. They both have $100 million in capital, and they both generated $80 million in earnings before interest and taxes, or EBIT. Case 1 runs on 100% pure equity. Case 2 uses a 50-50 mix, $50 million in equity and $50 million in debt at a 10% interest rate. Because Case 2 has that $50 million in debt, they have a $5 million interest expense. Notice how Case 2's $5 million interest expense directly lowers their taxable income. The earnings before tax drops from $80 million down to $75 million.
And here is the profound result of that math. Even though the company in Case 2 took on outside debt and had this extra expense to pay, they actually end up writing a smaller check to the taxman. Case 1 pays $12 million in taxes, while Case 2 only pays $11.25 million. The debt has literally shielded a portion of their income from taxation.
That difference is a direct tax saving of $750,000. So think about this. Case 2 paid $5 million to their bondholders in interest, but the government essentially subsidized $750,000 of it by lowering their tax bill, meaning their $5 million interest payment effectively only cost them $4.25 million out of pocket. I mean, that is just the incredible power of the tax shield effect in action.
We've mastered the cost of debt today, and it's super clear why heavily leveraging debt can be such an attractive financial maneuver for corporate growth. But, debt is just one piece of the WACC puzzle. So it leaves us wondering, what happens to the formula when a company issues preferred stock instead? How are dividends treated differently by the tax code compared to those interest payments? Keep that crucial question in mind as you process everything we covered today. Thanks for joining me on this explainer, and I really hope you're walking away with a crystal clear understanding of the cost of capital.